Welcome back to my weekly QQQ trade series. Today, I've got a good problem. The share price of QQQ keeps rising, and it's looking like I may need to take some profits. For anyone new here, I'm Patricia Saylor, managing partner of Saylor Financial Fundamentals. I demonstrate real-time trades and teach others how to invest and trade options. Today, QQQ is trading at about $526 a share, which is well above both of my strike prices. Unless the share price pulls back significantly, it may be hard to get ahead of it again. That said, I have a cash secured put expiring today and a covered call expiring next week on December 13th. Here's the good news. My covered call's strike price is well above my break-even point, and I also have 26 additional shares that aren't at risk of being called away. This puts me in a comfortable position, even if it's time to reset with new strike prices. For today's trade, I'll pick up a little extra premium while letting the remaining extrinsic value of my covered call erode over the next 7 days. Before we dive in, I wanted to share some news. I've been trading bull put spreads in one of my accounts for a couple of months with good success as I gain confidence and develop strategies to manage my risk. My biggest challenge hasn't been the trading, it's been figuring out how to teach it. I'm almost finished preparing video scripts and written content that will either become a new chapter in the Novice Investor's Guide or maybe a standalone mini book. So look out for a new playlist and fresh trades coming in early 2025. I can't wait to share them with you. But for now, let's do a quick assessment of my QQQ position, bring in a few dollars while we wait to wrap some things up, and I'll show you my prediction for next week. QQQ is trading at $526.48 a share, and I have a $497 put expiring today. So right now, it's only worth about a penny a share or $1 to close it. And I know that when I have a put on expiration day this far out of the money, it's often very hard to actually get a closing order to execute. So I'm just going to leave this one alone and let it expire at the end of the day. I also have a $501 covered call that expires next week. And if you look over to this column, the extrinsic value column, you can see that it still has 63 cents a share of extrinsic value. And that is value that will erode away between now and December 13th, as long as the share price stays above $501. If I wanted to close it today, I could sell 100 shares for $526.61 a share, and um, I could buy back this call to close it for $26.31. But that would cost me an extra $69 that I don't want to spend today. So I'm just going to leave this contract alone and look at it next Friday. I've been thinking a lot about this position today, and it seems like the share price is getting too far ahead of my strike prices for me to continue trading them in this way. So I'm going to look at what the outcome will be if I just wait until December 13th, let these shares be called away from me, and start fresh with new strike prices. So let's take a look at the spreadsheet. So right now, I have this covered call. If you recall, the last time I rolled it, I received $141.68. And the cash secured put that's about to expire today. The strike prices are far enough out of the money that they're really not generating much income for me. Now, I don't mind rolling an in-the-money covered call as long as I can raise the strike price and generate some premium with it. So it may be that next Friday I will increase the strike of this cash secured put, I'm sorry, of the covered call, and try to capture another $100 in capital gains. But it may be time to just let this position go and start fresh with new numbers. So we'll take a look at it next Friday. But in the meantime, I might as well pick up a few dollars just for my time by selling another cash secured put. And you know that my policy is I want to make sure that my um, the strike price of my calls is at least equal to or preferably higher than my cash secured put. So let's see if what I can get by selling a cash secured put expiring on December 13th with a strike price of 501 or less. All right, there is not much premium to be had, but as long as I'm going to be keeping these funds available in the account anyway for the next week and not using them for something else, $13 is $13, so I'll go ahead and sell this put, and we'll look at the spreadsheet, reconcile some numbers, and come back to this on Friday, December 13th. Right, let's talk for just a minute about what I expect to happen next Friday. And because this is a hypothetical outcome, I'm going to color it bright yellow. But I expect that next Friday, on the 13th, I will be assigned to sell 100 shares, and I will receive 501 times 100, and that the share price will be above $501 a share. So at that point, my total expense and income, going all the way back to when I started this position on May 16th, you can see the light yellow is shares I have bought and sold. The green cells are cash secured put income, and the blue ones are covered call income. So if I add it all up, at that point, I will be out of pocket $4,694.35, and instead of 126 shares, I will own 26 shares for an average investment per share of $180.55. And we'll check at that point to see what the net liquidating value of the 26 shares is. And then I'll start fresh with new numbers, and we will keep trading this excellent ETF that is performing well for me. I just have not been able to keep ahead. So honestly, there has been some opportunity cost here, but I'm still profitable, so I'm not complaining. I'll see you next week, and we'll start fresh with whatever the market gives us.